Okay. All right. Now, hopefully everybody can see it.
Yay.
So, again, thank you for joining. There's clearly a lot of information that you're hearing. Some of it's good, some of it's misleading at best. So I think we always want to put things into, facts. We focus on facts. So our number one concern as an investor, whether we're buying stocks or bonds, is to focus on earnings, right? If you're a business owner, you want your earnings to grow. If you lend somebody money, which is the equivalent of buying a bond, you want to make sure they make enough money to pay you back. So that's what we're hyper focused on. These 5 gauges are what we consider to be the drivers of stock prices over time. And the basic premise is if the gauge is straight up and down or at 12 o'clock, it's a neutral for our outlook for stocks. If the gauge is to the right, it's a positive. And if it's to the left, it's a negative. So a quick look, you can see we have 3 positive, 2 negative gauges. We had been at 4 positive, 1 negative gauge before. But importantly, the ones that are really drivers of stocks over the long term are all in positive territory, which is the economy, monetary policy, which is the Federal Reserve, and interest rates. So I'll talk a little bit about each of these right now. So the economy, I think, is one of the ones that I see the most misleading information about on television. And everyone talks about how bad the economy is. And primarily, people that take that view are focused on unemployment. And unemployment's 6%, which is, we were at 3.5% before the pandemic. So it's clearly higher than it was before the pandemic. But we got as high as 14.7%. So we've made a lot of progress on that. And importantly, the unemployment numbers really don't tell you where the economy is going. They tell you where the economy has been. And in technical terms, they call that a lagging indicator. And if you think about it again from a practical standpoint, if you have a business, you wait till your business is fully ramped back up before you're bringing people back on, and before you're hiring new people. You'll work your current employees with some overtime before you add headcount. And that's really what happens. That's why that unemployment number always trails behind what's going on in the business. Most of the unemployment is still centered around the hospitality and leisure space. The restaurants, hotels, airlines, things like that. I was just telling Patricia, I flew for the first time for business in a year. And on my flight from New York to San Francisco, the flight attendant was so excited because I was on the plane in a suit. I heard her talking to the other flight attendants and said, "My God, the business people are back." And then she had to come over and ask me what I did for a living and all that. She was so excited to see business travel. So that, as we get further ahead on the curve with the vaccines, that's coming back. Over half the adults in the U.S. now have had at least 1 shot. We're seeing the numbers, go down dramatically in terms of new cases. So, as time marches on and we all come out of hibernation, that unemployment that exists in the hospitality and leisure space is going to go down. Things that we look at in terms of what's going on in the economy that tell us where the economy is going are all in really good shape. And a great example of that is the housing market. If you look at housing, whether you look at new home sales, existing home sales, housing starts, building permits, house price appreciation, they're all in really, really good shape. In fact, housing's not only got back to where we were before the pandemic, we're back at levels that we haven't seen since before the financial crisis, which is pretty impressive. And housing, it usually gives you a view of where the economy is going 6 to 12 months out. And with this type of a unbelievably strong real estate market, that's a pretty good omen. We think the economy in the U.S. is going to grow over 6% this year, which we haven't seen that kind of growth in a very, very, very long time. A lot of pent-up demand. One of the reasons housing is such a good leading indicator is because it speaks to certainly consumer sentiment, right? You don't go out and buy a new home or unless you feel pretty good about your condition, right? And if you've ever gone through the mortgage process, I'm sure you know that banks will not lend you money unless they agree that you're in pretty good condition. But what we've seen through this pandemic, I don't think many people would have guessed it, is that people paid down debt to levels that we haven't seen in a very long time. They increased savings and they still managed to spend money. So if you look at retail sales, which is what consumers spend on everything other than their housing, that's the highest level ever. And that's pretty impressive. So why does the economy matter so much? Well, the economy drives earnings and earnings drive stock prices. So with this really strong economic rebound that we've had, we've also had a really robust rebound in earnings as well. So if you went back a year ago and looked at where earnings were for the S&P 500 in total, and compared it to the first quarter of this year, 2021, earnings are up 100% year over year. That's pretty impressive. Stocks are up, call it about 90%. So the other misleading information that I hear is that the stock market is hitting new highs, the economy is horrible, and it's completely disconnected with reality. And that's just not true. The earnings growth is actually supporting the stock market move. And what you'll see this year is that earnings are going to go up a lot faster than the stock market. Stocks are up about 11% or so far this year, but earnings for the S&P 500 for the full year are going to be up about 45%. So this is the way it always works. Stocks lead economic data, stocks lead earnings, and then everything else then catches up. So economy is in very, very good shape. We have that halfway in the forward position. We arguably could have this all the way full positive if we chose to. I don't know if there were anybody dialed in on the phone, but it's about 2:30 if you think of a face of a clock. So definitely right at 12 o'clock. Monetary policy is the next gauge over. We have this all the way positive. So monetary policy is fancy term for what's the Federal Reserve doing. And the Federal Reserve can stimulate or slow down the economy by controlling interest rates. What they did a year ago is they basically lowered the federal funds rate or the Fed funds rate to 0. So that's their normal tool. In addition to that, they did what was called quantitative easing, which they did during the financial crisis, is they're buying a whole bunch of treasury bonds and notes and mortgage-backed securities in the open marketplace to keep rates down. They're buying about $120 billion a month, and they've purchased over $3 trillion in the open marketplace. So in addition to the $7 trillion or so that the government has thrown at this through spending, the Federal Reserve's thrown another $3 trillion. Trillion here, trillion there. Sooner or later, it's real money. That's, put it in perspective, that's about 50% of the size of our economy. So the Federal Reserve, the way I think of them is there's a gas pedal and a brake pedal. They've got their foot on the gas pedal. They've not only got their foot on the gas pedal, but they've got it all the way to the floorboard. And according to their language, it's staying there for a while. Why is that important? Is that historically stocks do well when the Federal Reserve is trying to stimulate the economy. Stocks start to do less well when the Federal Reserve takes the foot off the gas and starts to hit the brakes, right? And this will be a multi-step process. So the first thing they're going to do is you'll hear the term tapering. What that means is that $120 billion a month that they're buying in terms of treasuries and mortgage-backed securities, they'll reduce that amount slowly, right? They're not going to just cut it off. Maybe they'll go from 120 to 100 and then to 80. So they'll taper that down. When that is done and when they feel comfortable, that's when they will start to raise rates. So first it's letting off of the gas pedal, and then eventually they're going to start to tap the brakes. Now, once they start to raise rates, it doesn't mean that things are over yet either, because if they're tapping on the brakes, that means the economy is still very strong. I started in the business in mid 80s, and they used to call it 3 steps and then a stumble. That meant that the market could handle 3 rate increases because they were looking at how good and strong the economy was. And then they'd start to worry about what could happen, because the Fed's hitting the brakes to slow things down. And that's when the market starts to get a little bit more challenged. So for right now, the Fed made comments yesterday, foot is all the way to the gas pedal, keep your seatbelt on. This is a lot of liquidity into the market and to stimulate the economy. The next gauge over is valuations. So we do have this as one notch negative. And a couple things. So what we mean by valuations is, what are you paying to buy this company versus what they're earning? So the common way to look at it is, think about it. If you're buying a business in your town, if it made $100,000 a year, that's kind of what you would probably likely base what you would pay for it. So if you paid, $2 million for a business that's making $100,000 a year, it would take you 20 years of making $100,000 a year to get your investment back, assuming earnings never grew. So that's a very common way to look at the stock market right now. Right now, you're paying about $23 for every dollar of earnings. So again, what that means is, if you earn $1 for the next 23 years, you'll get your investment back. And that would imply about a 4.5% return on your investment. Sorry, I'm doing this with a mouse. It's not so easy. And then there's about a 1.6% dividend. So kind of what the market's pricing in is about a 6.1% or so return. That's not our forecast, but I'm just saying what it's telling you is that expected return is a little lower than the long-term average of stocks, which is more like in the 8 to 10% range. It doesn't mean the market needs to go down a lot, because, as I said, earnings are catching up very fast. So this E is growing much faster now than the P. So this valuation gauge could very well shift back to neutral, even if stock prices keep going up. And the important thing is that when you look at that implied return of about 6.1%, if you compare that to where the 10-year Treasury note is, that's 1.6%. Right? So stocks still look attractive when you factor in how low interest rates are, and they still look attractive as an investment relative to bonds. The next gauge is investor sentiment. This is a really volatile gauge. You can think of this as a weather vane that spins as the wind changes direction. And what we're trying to measure with this is investors' fear level and greed level. Right? So when we were in the worst part of the pandemic a year ago, we had this gauge all the way over and positive. Why? Because investors were terrified. Right? They were pulling money out of mutual funds at a record clip. They were basically just wanted to get out of the market. When fear is that elevated, that's exactly when you want to be buying. Right? Warren Buffett says it pretty nicely. You want to be greedy when people are fearful, and fearful when people are greedy. So what we're seeing now, we've got that gauge halfway negative. Why? Well, people aren't as afraid anymore, and you're seeing a lot of new investors into the market. You're seeing a lot of strange price movements on stocks because of this excitement. Think about what GameStop did before. You can think of something like even like a Bitcoin, where there's a lot of enthusiasm around something by investors that really are not professional investors. And that shows us there's some levels of speculation in the marketplace that tell us that, maybe we've just had a really fast 100-yard sprint. Maybe we need to take a breather. The good thing about this is it changes direction pretty quickly. So back in January, we had about a 4% correction or pullback in the market, and this gauge would have shifted over into the positive territory. So it doesn't take much to move this back into positive territory. Inexperienced investors are the most emotional ones out there, and I always equate movements in the stock market to turbulence on a flight. And when you hit about a turbulence, it's really easy to figure out the people that are new flyers versus the people that fly a lot. And the same is true in the stock market. You get a little turbulence, if you got a 5% pullback in the market, those new investors, inexperienced investors, are going to be running for the hills. That's great. We love that. because that provides opportunity for us to that have a much more disciplined way of deciding what we're going to buy, to get opportunities to get things. And in the grand scheme of things, while 5% correction is never fun to see, it's common. In fact, on average, going back to the 1920s, you have a 5% correction or more 3 times a year. That's just normal, right? And you get a 10% correction about once a year. But we also know that as long as the fundamentals look good, that the stock prices come back. These new investors don't think that way. So they see the value go down, they panic and they get out. That provides good opportunities for us. And then lastly, interest rates. We still have this as halfway positive. We had it as all the way positive before. We brought it back one notch. And the simple reason is that interest rates have gone up some. Right? Now, I was talking about what the Federal Reserve does with interest rates, but there's also the interest rates that are in the open marketplace. As I mentioned, the 10-year Treasury is at about 1.6%. Went back to August of last year, it was just over 0.5%. So interest rates have moved up some. That has a short-term effect on bond prices. So we've seen that bonds have been a little bit more challenged since interest rates have moved up. But there's a lot of really good information that comes out of the bond world for both the economy and for the stock market. So one of the things that we always look at is, all right, what's the yield on a 10-year Treasury? As I mentioned, 1.6%. And then we'll compare that to the yield on a 3-month Treasury bill, so much shorter. So now the 3-month Treasury bill is basically almost doesn't have a return. It's about 0.01 or 0.02 in terms of the return. So that's a good thing. When the longer term rates are higher than short term rates, what the bond market is telling us is that we're pricing in future growth. When, as I mentioned, the Federal Reserve has the gas pedal on the brake, well, when they start to tap on the brake, what they do is they raise the Fed funds rate. That will push up short-term rates much faster than it does on long-term rates. In fact, a lot of times long-term rates don't move. So what will happen is they're raising rates. Ultimately, you get into a condition which is we call this an inverted yield curve, which is the technical term. But what we're really saying is, maybe short-term rates are at 2%. And long-term rates are still at 1.6%. So when short-term rates are higher than long-term rates, that's a warning sign that we're probably going to have an economic slowdown period. Typically, stocks don't like that, and that becomes a more challenging environment. The Federal Reserve is probably not going to be raising rates until 2023, maybe 2024. So we've got a lot of runway there in terms of what the market's telling us. So overall, the fundamentals look really good. Our year-end target for the S&P 500 was 4,150. Right now, last I saw, we were about 4,190. So we're actually about 1% above what our year-end target for stocks was. And it's played out pretty much how we thought. We said the front half of the year was going to be very good. Where the market's discounting all kinds of good news. $900 billion stimulus package at the end of last year, a $1.9 trillion stimulus package the first quarter of this year, a couple $1 trillion infrastructure program, and very importantly, wide distribution of vaccines. It's hard to top that good news in the second half of the year. So we think a lot of the easy money, if there ever is such a thing, was made in the first half of the year. And the second half of the year is probably going to be a little less exciting than the first half. So just kind of keep that in perspective. That's not saying that the market needs to go down a lot. It's probably not going to continue to go up as at the same pace that it has. That being said, the market has a history of going further and faster than people think in either direction. And usually when we're in this upward trajectory, it can have some pretty good strength going forward. So those are the big picture things on the economy and the stock market. I'm going to jump forward and share what I think are some of the things that I'm hearing in terms of what concerns are. Those would include bonds, inflation, what's going on within the stock market, and volatility. So why do we own bonds? We own bonds. It's to generate steady cash flow in terms of the interest payments and to offset the volatility of stocks. Right? Stocks, we know over the long haul, have the best return, but they also have a lot of volatility to the point that most people couldn't handle it if they had a 100% stock portfolio. Bonds are a lot less volatile. So if you look at the Bloomberg Barclays Aggregate Bond Index, which is a very long name, but it's essentially like the S&P 500 for the bond space. So it includes treasury securities and investment grade bonds. That index started back in 1976. And there's only been 3 years where it's actually had a negative calendar year return: 1994, 1999, and 2013. 1994 was the worst year, and bonds were down a whopping 2.92%. And to put it in perspective, the Federal Reserve raised rates 6 times that year, right? So that was a challenging year for bonds, but think about what the worst year for stocks has been. You know, we saw a 34% pullback in stocks in a month last year. So a lot less volatility in the bond space. So that's one of the main reasons we like to have those in the portfolio, so that you can sleep at night. The important thing is that we own the individual bonds. So even if interest rates went up a lot, we can hold that bond because it's literally a contractual obligation with the issuer that we bought the bond from to pay us interest twice a year and par value back when it matures. That's a very, very important feature. So while it may go down in price in the short run, we're gonna, we have the luxury of holding it and collecting those interest payments. And we know as long as those issuers don't default, meaning that they can't make their payments, and we have an investment grade rated bond portfolio in our corporate bonds and municipal bonds, as long as they can make their payments, we can tell you to the penny what your cash flow is going to be, which is really important. That's an important thing to know. That should give you comfort that, okay, well, maybe the bonds are down a little bit, but do I care? I'm going to get my interest payments and I'm going to make my par value back when it matures. So that's important. Just showing you kind of over a period of time what that has meant is that if you look at just a 1 year period and look at what the best year in stocks have ever been on a rolling 1 year period, it's been up 60%. Also had a period where it's down over 40%, right? Bonds is the orange on this thing, a lot less on the upside and a lot less on the downside. And when you put that together, let's say you had 60% in stocks and 40% bonds, what you end up doing is participating in the good side of the equation and limiting how far down it goes. So trying to create a smoother ride for the investment portfolio. And if you go out over time, go out to a 10-year period, 60-40 portfolio, you've never been down on a rolling basis. So that's also good to know. And again, if you look, this is the percentage of times that you've been positive. While stocks on a short-term basis, you're about 83% of the time it's positive. Bonds are more like 90%. As soon as you get out to 3 years, bonds are almost 100% positive at the 3 year mark and certainly at the 5 year mark as well. So time helps as well. Skip that page. So one of the other big concerns I'm hearing is inflation. And we've been at about 1.6% inflation. The Federal Reserve has been trying to get it up to 2%, and everybody's panicked now. Everybody said, oh my gosh, we're going to have runaway inflation. Inflation's horrible. And it's amazing how quickly opinions changed on that, because a year ago, everybody was worried about deflation. Prices were going down and the US was becoming Japan. Here we are a year later, and now the panic has gone the other direction. So will inflation get above 2%? Probably. Right? The Federal Reserve wants it to. Prices might go up further than that in the short run. And the Fed calls it transitory inflation, which is a fancier way of saying temporary. And the reason is simply that a lot of demand's coming back as we come out of hibernation. and the supply is going to take a little bit of time to catch up to that, and then prices will start to stabilize again. But we've gone through periods of time where we've had inflation. So you look at the decade of the 90s, we had 3% inflation on average for the decade of the 90s, and stocks were averaged 18% a year in the 90s, and bonds averaged 7.4% a year in a 3% inflationary environment. So it wasn't the end of the world. In the 80s, 5.5% inflation, and stocks averaged 17.3%, and bonds averaged 12%. So the bottom line of all this is, yes, we're going to see a little bit higher inflation, but it's not the end of the world. It's, you know, I say it's like taking your temperature. If it's too high, you're sick. And if it's too low, you're dead. What we want to do is have a nice moderate level of inflation that puts us more like that 98.6 that we want. And that's where we think we're headed. I mentioned, you know, the rotation in the market, and we saw this last year during the first 8 months of the year, where just a handful of stocks that were really primarily growth stocks were the only thing that were working. So, you know, the Facebook, Amazon, Netflix, Microsoft, Apple, and Google, which we call the FanMag stocks, they were the only stocks that were going up. The boring, consistent earnings growers and dividend growers trailed behind. And then the world changed. As interest rates bottomed in August and started to go up, reflecting a stronger economy, the boring stocks, the dividend growers, and the value-oriented stocks started to do a lot better than the growth stocks. So that's what you see in this 7-month column. So the S&P 500 up about 14.6%. If you just take out the size effect, because the bigger the company is in the S&P 500, the more a part of that index it is, meaning that it accounts for more of the return. So if you just look at the average stock, it actually did better, up 28%. So that means the smaller, mid-size, and smaller companies were starting to do better. If you look at the growth versus value situation, that's right here. Russell 1000 growth stocks up 7%, Russell 1000 value stocks up 26%, and our Facebook, Apple, Netflix, Microsoft, Amazon, Google up 2.4%. So the tech stocks, they're great. They're good companies. We own them in different places, just not to the same weighting as the S&P 500 has it, because to us, that's way too concentrated. It's not enough diversification. It's not enough risk control in your portfolio. So, you know, they don't need to necessarily go down a lot, but everything else needs to catch up. And that's precisely what is happening right now. And if you look over the long term, this chart, it shows you how growth stocks done relative to value stocks over a long period of time, going back into the 30s. So if the line is going down, that means value stocks are doing better than growth stocks. If the line is going up, that means growth stocks are doing better than value stocks. So we just were in a pretty long period of time, actually. You can see these green shaded areas are where growth stocks were outperforming. Over the long term, you can see that the line has gone down, which means value stocks have done better than growth. But this was a very long period of time where growth stocks actually did better than value stocks. And you can see this is what we saw last year, this part right here, where growth stocks really outperform value. Now you can see the line coming down, and value stocks are coming back into favor. But it looks an awful lot like this period in the late 90s, where all of a sudden you had growth stocks just absolutely far outpace the value stocks, followed by this period of time where value did a lot better. We think that's the kind of period that we're in. Value stocks tend to do better when the economy is really strong, like it is right now, and we think we have that tailwind for a while. So we would expect that those types of companies and what are value companies? Things that are like in the industrial world, in the financial space, those are typically kind of value oriented companies, and they should do well going forward. And then volatility, last year we had 109 trading days that the market moved by 1% or more, right? A 30-year average, 64 days is an average. So we far surpassed that. Went back to, this was the financial crisis where we had a lot of 1% moving days. So far this year, it's been, it's been relatively muted. We have had 18 days in the first quarter. So from January 1 to March 31, that the market moved 1% or more. Most of them were up. So that was pretty good. I think we've had five more days so far in April. So volatility settled down from a really, really high level last year. And one thing we always get asked, well, the market's up a lot, is now a good time to buy? So, if you go back and look, there were three time periods I could say that right before the market had a big drawdown, it went down a lot. And you could say that if you stuck with what you did, it worked out for you. So if you bought stocks on March 24th of 2000, which was the top of the tech bubble, September 10th, 2001, obviously the day before 9/11, we were already in a recession. And October 9th, 2007, that was the top of the market before the financial crisis, right? And if you bought the S&P 500 and just held it to March 31 of this year, you were up 160%, 264%, and 154%. That's even after dropping by 50% right after you got in. So what it speaks to is stay focused on the long-term plan. That's important. Have the right blend of stocks and bonds so that you're not all the way down 50% like the stock market would be, because bonds typically help with that volatility. That's why, working with Patricia, that's what we try to do, is build out a portfolio that you can sleep at night with. Right. So we don't want to give you too much volatility, because you'll be up all night. And if you don't have some volatility in there, you're not going to have any growth, right? Because stocks are really the big driver of growth over time. So that's an important thing to consider. And this is, a long-term perspective of what stocks have done. We've had 3 periods in time where stocks for about a decade really didn't do much. You can see that with these kind of red boxes. They sort of went sideways. And once you got out of that period, you had strong, big long-term bull markets. And that's what we've been saying since 2009 that we're in. Doesn't mean you don't have corrections along the way. We have in all of these periods, but we do think we're in this longer-term uptrend in stocks. And just to make everybody's compliance department happy, I have a disclosure page, which I'm going to read to you. No, I'm not going to read it to you, but it's in there, and description of all the benchmarks and things. So with that, I will stop sharing my screen and see if we have any questions. I think Patricia mentioned you can down the bottom of the screen, there's a chat function. You can click on that and type in a question. I think you'll have a choice of sending it to me, Patricia, or Jeff. Nobody else will see it, so don't be embarrassed. Don't be shy if you have any questions.
So Glenn, while people are considering if they have any questions, I did gather some questions from my clients in preparing for this call. And one of the questions was, I guess you touched on it a little bit. Interest rates are low, housing startups are high. Housing startups are high, and that's great for the economy. But what's going to happen, or what should investors expect as interest rates start to rise? What does that normally do to stocks?
So usually rising interest rates, typically stocks do pretty well, because what those rising rates are indicating is stronger growth. And that's what we're seeing right now. It's a little more challenging for bonds in the short run, because bond prices move the opposite direction of interest rates. But it said, as we can hold them to maturity and know we'll make money on it. But if interest rates are going up for the right reasons, because there's strong demand out there and indicating a lot of growth, it's typically a pretty good environment for stocks. And if you think about it, if you're worried about rising rates and if you're worried about inflation, the best protection that you have is to own stocks and to own corporate bonds. Why? Because companies can raise prices to protect their profit margin. So if there's a lot of inflation, you know, these companies can raise prices of the final goods that they sell and they'll still make money. How we know what you don't want to own? Cash, right? Because if prices are going up, you're not making any money on cash right now. And you know you're losing purchasing power every day that inflation goes up and you're earning nothing. Now, I'm not saying you shouldn't have some cash. Obviously, you know, that's, Patricia, what you do with people with financial planning. You want to have a nice amount of money set aside so that if you need it, you're not forced to sell from your stocks or bonds at what could be an inopportune time. That's why it's always nice to have a little cushion in cash. But you know, from our perspective, this gradual move up in rates that we're seeing is actually really positive. It's a good environment for stocks.
Okay. And then one question I had is I'm seeing a lot of news about the government proposed tax increases, and, you know, Congress is negotiating this or discussing it. If we do see a tax increase in 2021, any thoughts on how that might impact the market?
That is a fantastic question. So if you go back and look historically at times when the tax rates have been increased, if you go back to the 30s, there were 14 times that the top marginal tax rate was increased and 17 times that it was decreased. And what was interesting is stocks actually were up about, I think it was about 7.9% in years when taxes were raised, and they were only up a little less than 2% in years when taxes were lowered. And what was interesting is if you looked at those time periods where taxes were increased, it was in the 30s during the Depression, 40s during World War II, early 50s during the Korean War, late 60s, early 70s during the Vietnam War, and then the early 90s with whichever Persian Gulf conflict you want to throw out there. So taxes went up and were in conjunction with a big government spend to fix a problem. Right? Sound like a familiar time period? It's exactly where we are right now, right? The government spending massive amounts of money to jumpstart the economy, and we'll see taxes go up. So that was on the personal income tax side. The same is true if you look at long-term capital gains. They were increased 10 times and decreased 11 times, and stocks did better in years where they went up. Now, that's history, and I very rarely say it's different this time because those are the most expensive words in our business, because it rarely is. This is a pretty significant potential change. And if they increase the long-term capital gains rate and simultaneously get rid of the step up in basis at death, which is what is being talked about, that could create some selling pressure where people might want to book gains in 2021. The variables are, all right, what's the ultimate rate going to be? Because they're still working that out. What income level does that kick in for? They're still debating that. And when does it become effective? Is it going to be 21 or 2022? And, you know, we don't have any better crystal ball than anybody else in terms of trying to figure out what our friends in Washington are going to do. What we've always seen is that, you know, trying to look through a crystal ball to figure out Washington is a lot more like looking through a snow globe. There's a lot of murkiness in there. So, you know, we're hyper vigilant on what's going on. We understand taxes are extremely important to our clients. We do a really, I think last year we proved that, what a good job we did in terms of keeping the tax bills really low for our clients, while even though the market was up. So we're going to stay focused on that to see what the ultimate outcome is, and be ready to act accordingly. Inside the portfolios, you know, corporate rates go up as well. That's on the table. The top corporate rate's 21%, had been 35%, and, you know, might go up to 28 or 25%. So we'll be looking to see which companies and industries would be most affected by that. It won't make companies not make money. It will make them grow their earnings at a slower pace. But keep in mind that taxes were at 35% for a long time, and companies were able to make money. We as investors were able to make money. Higher taxes, it's hard to make a fundamental argument why they would ever be better for the market. So, we'll keep an eye on it, but it's not the end of the world. Like everybody, the media is going to want to make this sound. They get paid to keep us glued to the news and be terrified. But, the reality is somewhere always in between the extremes of what gets reported, I think. I think, yeah, we had a question come in about corporate tax rates. I just talked about that.
Fantastic. Okay. Glenn, I don't see any more questions on my chat file. Do you see any?
I do not.
Okay. Well, then thank you very much for taking the time and speaking to us. For our clients, Specimen Wealth Planner clients who've joined, hopefully this was informative for you. If you have any questions, reach out to your advisor and we can try to follow up and answer any questions you have from this presentation. But Glenn, Jeff, thank you both for your time, and I hope you guys have a wonderful week.
Thank you. Our pleasure. Be well.
All right. Bye now.